Hey everyone, before we get started, I just want to give everyone that attended my live training yesterday a huge thank you. You had great questions, and I enjoyed interacting with my members. It was truly fun. In case you missed it, yesterday Josh Martinez and I debuted a brand new strategy that lets you bet against dumb money. That's right, you heard it right, dumb money. And by dumb money, I mean trading strategies that are outdated and no longer work. So far, the results have been amazing. Gains of up to 482% and a 70+ win rate, 70+% win rate. The good news is that if you missed it, we're making a replay available for a limited time. In it, I cover popular strategies that consistently lose money, how you can flip these strategies and make 400% plus gains, why it's possible to close 69 winners in a row using smart money spikes. Can you imagine 69 winners in a row? And how to trade the signals that the system is giving now. Make sure to click the button below, watch the replay while it's still up. You don't want to miss this. This is fantastic stuff, groundbreaking things you've never heard of. Follow the link below. Do it now. All right, folks, I want to give you a little update. I haven't done a video last few days, so I want to give you a little update of what's been going on in the market. Unfortunately, this coronavirus, remember, no cases, 5 cases, 10 cases. Now there's 5,974 cases, and it looks like it could become a global epidemic. If that's the case, and remember, when it comes to diseases, earthquakes, unforeseeability, the market can't assimilate or price it in, so we can see a extended downside in the S&P 500. We've been coming up and we've already filled the gap, but the question is going to be whether we take out these highs or not. Now, a few things to talk about. Existing home sales. Now, I know I told you that I said I told you so, but 29 days ago, beginning of the year, I told you guys that the worst, in my opinion, this year, the worst sector is going to be the real estate sector. And I got a lot of emails, a lot of people telling me, no, I don't think real estate's going to slow down. Well, existing home sales came out today, and the number has been the worst number in 9.5 years. I've been talking about a slowdown in the real estate sector. I've been talking about it lagging behind. I've been talking about a stronger stock market, weaker real estate market. Weakest numbers in existing home sales in 9.5 years. That's substantial. And remember, the Fed is not interested in real estate. They're interested in the stock market because interest rates are low. They're going to remain low, but the housing market is starting to feel it. So you got the coronavirus. You've got this impeachment that's going on right now. You've got existing home sales. That's not positive. That's negative, very negative. And this impeachment, there's a lot of new evidence that's coming out that's starting to make it look not so good for President Trump. Now, the odds of him coming away with this undone, unscathed is pretty good. He's probably going to. This is going to be just a dip in ratings, I believe. I think things are going to move up long before re-elections, which is several months away. But it is something we have to consider and we have to watch, and the market is pricing it in. So right now, we saw the pullback that I've been expecting. If it wasn't the coronavirus, it would be something else. Now, the positive. Let's talk about positive. Apple earnings. The earnings per share came out at $91 billion compared to $88 billion. The stock is making all-time highs. Revenue, the expectation was about $62 billion. The number came out at 63 to 67, roughly there. So it beat the revenue as well. Apple right now is making new highs. As a matter of fact, let's take a look at Apple. It's not wise to bet against the strongest stock in the world. And remember, Apple has huge market cap right now. So the question is, are the broad markets going to follow Apple or not? A lot of it depends on fundamentals. Remember, we have a lot of Fed data on the table. So for example, we had FOMC meetings that's coming out a little bit later today. We have the press conference, and then tomorrow we have GDP and jobless claim. Expectations for GDP is at 2.1%. Anything over 2% is going to be bullish. So in my opinion, whether stock market rallies or not is going to depend quite a bit on what the Fed says and what the GDP and the jobless claim will be. Now, here's my take. I believe jobless claim is going to be positive. Why? Because we've been at, the unemployment rate has been fantastic, clear as day. And I think unemployment cost indexes or personal income is going to be very favorable as well. Unemployment has been very good. GDP, I think, will be solid. I think the earnings have not been that bad. And I think retail has outperformed overall. So I think the GDP will be at 2 to 2.1%. If the GDP is not at 2 to 2.1%, the Fed is going to have a problem. This is why I think it's really dumb to have the FOMC meeting before the GDP. It's kind of wise to have the GDP so you could see and base your opinion on that. But what do I know? I'm not the Fed, right? I mean, this doesn't make any sense because the GDP kind of nullifies what the Fed says unless it's completely in line. My guess is the Fed is going to say we're going to see if China and U.S. trade war is going to continue. We're going to see if the economy keeps moving on. We're not going to lower rates. We're not going to raise rates. We're going to leave things steady and see how things go. And then the GDP is going to come out the next day, and it's either going to validate that or not. Either way, I would pay attention over the next day or two to the bond market. Right now, I believe the bond market is going to break lower. I don't think we're going to see a lot of upside. I think any upside we're seeing is minimal. We're already stalling out here. We did break resistance, but I believe we're going to come down and that the long-term bond is going to trade lower. There's really no reason for it to trade higher unless the stock market see a major sell-off, and I just don't see that. There's nothing to cause that. Again, we have big Fed data. We have 3 big reports. We have GDP, we have Fed reporting, and we have employment data before the end of this week. So there's 3 big reports starting with the one in about an hour. And then we have more earnings this week. So expect increased volatility. Watch the S&P and see if the S&P can make all-time highs. I will say this. Smaller stocks continue to outperform, and they're going to outperform the large caps till we see something not happening with Trump and China. If the trade agreement doesn't work out, then small caps are going to start heading lower. But if things remain status quo, we can expect more upside and relative strength on the smaller stocks to outperform large cap stocks. Again, keep your eye out on the GDP report. That's the biggest report of the quarter. It's coming out tomorrow morning, and it's going to set the stage for the Fed for us to determine, or for the Fed to determine where they're going to go. Hope that helps. Now, folks, thanks again for attending the training yesterday. It was amazing. It was so good that when we ended it and people went to the page to purchase, the website crashed. It's the second time that's ever happened. Don't forget, click the link below. Watch it now in case you missed it. You're going to pick up some amazing nuggets. Josh was just brilliant. I hope you liked what I had to say. Don't miss it. It's up for a limited time. Watch it now. Thanks again. Talk soon.